Matt, one of the challenges that Matt put forward to us is to put ourselves in the shoes of institutional investors. But for this panel, we're going to put ourselves in the shoes of donor organizations, development agencies, and the challenge they face by the cut of official development assistance and political decisions that have been made around the world around the rationale for ODA budget. And we are also going to hear from an MDB, the EBRD, about how those changes and also the pressure to do more with less is translated in an MDB. So we're going to start, we're going to try to do about 40-minute exchange with a panel. We prepare some questions, but we want to keep the discussion fluid, so feel free to intervene and contradict one another. This is really intended to be a discussion. And then we'll set aside 10 minutes for Q&A. I'm sure there will be lots of questions. So the first, maybe, going to you, Hito. JICA is a very powerful and very large development agency with a whole suite of instruments, including blended finance program, which you deploy bilaterally. So how is the ODA decline going to be translated with JICA operation? And in particular, does it mean a change to the way you are deploying blended finance program?
Well, thank you very much. First of all, thank you very much for having me. And I also would like to congratulate the Convergence for 10 years anniversary and thank for all the team to make it happen. And to respond to your question, I have to start a gloomy story. Japan is also facing the fiscal pressure with growing budget for defense and also the social securities because of course, the geopolitical situation and also the aging society in Japan. Under the current administration led by Prime Minister Takaichi, we expect the continuity of the foreign policy, including ODA. So we hope we would like to try to keep the same level of the ODA budget, but it is increasingly more difficult to keep this level. Another source of the pressure is increasing criticism to ODA among people. Recent poll tells that the public support to ODA has been declining among people. So we need to demonstrate ourselves how ODA effectively utilized and how we bring the real impact on the ground. JICA has traditionally focused on sovereign operations, concessional lending and grant assistance and technical cooperation. Recently, we have increased private sector investment, which is impact investment. This shift aligns with global discussion, including at FFD4, on how to mobilize domestic and private finance to scale impact. And we would like to mention some challenges to realize investment. So how we can improve the investment environment of our partner countries. I think the DFI, we can still work on it to improve the environment, namely the regulatory framework and institutions and human development. So we need to improve our collaboration, how we can address these issues. Another challenge is disclosure of IMM. FDI, like us, traditionally use 5 evaluation criteria under the OECD DAC framework. However, those are not sufficient to convey the clear and compelling result to impact investment communities. Now, impact investment community is open and variety. So we must be, mindful of how we can present the impact in a way that resonate with impact investors and stakeholders. Those are the challenges. Yeah.
Thank you very much. That's very interesting. So making the case, making it more compelling at all levels, investors, but also the wider public. So there is public support. Christian, SECO, very different agency, very powerful, but of course of a different scale. And how does SECO deal with that environment, and what are the choices and perhaps the trade-off that SECO has to make in relation to blended finance?
Yeah, thank you, Frederique, and let me start also with saying happy birthday, Convergence. Very happy to be here. Let's take a step back and maybe look at the big picture trends that shape our work, and I think that of many peers. And I think the first one you already mentioned, that's really the decline of ODA and growing skepticism. I would take this together about the effectiveness of ODA. So this forces us really to do more with less, measure with greater rigor, and engage with the private sector both in OECD countries as well as in developing countries, more effectively. Second, I think national interests or domestic benefits are on the rise, so this pressures us to demonstrate how our actions support our own economies in the long term. And third, the shifting geopolitical landscape that pushes for market diversification, and I think that's actually a huge opportunity for emerging markets, because investors have focused for too long on the US and Europe and some other markets, and I think that's going to be a huge push. And then fourth, the demographic shift and growth. I mean, if you look at Goldman Sachs' long-term forecast for 2075, you find hardly any European countries in the top 10. Bangladesh, Ethiopia will compete with France on rank 15. Ghana will probably surpass Switzerland. And so I think we have a very interested, our pension funds and also institutional investors go where the growth is actually happening in the next 25 to 50 years. And in the short and medium term, blended finance is definitely needed to push for this. Now, I think it's fair to say that the millions to trillions ambition has somewhat been aspirational, to say it maybe that way. We haven't delivered yet on scale, and this puts us under pressure, including from our management. But it's crucial, I think, to not throw out the baby with the bathwater, but to improve and to work on models that have been actually working. And I think this also showcases a bit our own journey at SECO. When we look back, and 20 years ago we've supported the first microfinance fund, and nowadays the Swiss impact asset managers have around over 10% of impact investments under management. And this evolution we also see in how we work. So we've been creating the SDG Impact Finance Initiative that bundles and pools concessional blended finance from bilateral donors and philanthropic foundations jointly. Actually, that was also with support from Convergence early on. So we support the pipeline of impact funds, but also provide first loss funding for impact funds. And we do this with the flexibility that is required by the private sector, while still guarding the mandates of each of the individual bilateral donors and foundations that we've heard about yesterday. So I think it's clear that the experimentation phase for blended finance is over. The time has come to analyze and standardize and scale the models that work, and I think the PIMS exercise that the Convergence is currently undertaking is really important in that regard. We also see positive movement of MDBs that has been mentioned, from originate to hold, to originate to distribute or share models. I think that's really great. So paving the way for institutional investors to come in to formerly uninvestable countries, frontier markets. But I think we still want to work much more on awareness in institutional investors, including on academic work to strengthen strategic asset allocation. How does this really fit into strategic asset allocations? And I think we need to come from a narrative that is maybe more shaped by moral imperative to diversification, opportunity, and business opportunity. And I think the trade-off that you mentioned for us is a bit, we don't have an additional budget for loans, but just the one for grants that we can use for blended finance, but mostly we do TA for reforms, as our colleagues at JICA mentioned. And just to take one example, the crop receipt program in Ukraine, essentially providing farmers with the opportunity to pledge their future harvest as a collateral. I mean, that was a 10 million TA grant from our side, and it helped to establish a 2.4 billion credit market in Ukraine with, by the banks. And so I think, while this is a powerful example, we don't see these kind of reforms delivering the same results everywhere. We need to be much more targeted in countries where we see the political will and commitment in the long term, and work. We see tangible results for important parts of the economy that really push for this. So I think, to conclude, the four trends that I outlined initially: declining ODA, national interests, geopolitical shift, and demographic and growth dynamics, we can harness that constructively, and I think blended finance really sits at the sweet spot of ODA today. So mobilizing private sector, advancing climate finance, driving impact, but we must use the most efficient instruments in blended finance, identify these, and combine them smartly with the enabling reforms that we have been doing for quite some time in countries and sectors that align with our national interests.
Thank you very much, Christian. So end of experimentation and doubling down on what we know is working, and playing strength. If you can do TA, you can do TA in a way that's really leveraging investment, as you took the example of Ukraine. You mentioned MDB, so that gives me the opportunity then to turn towards Geneviève. And Canada, of course, is not just a development agency, but you are also an important shareholder in MDB. So how do you see MDB's role evolving in this context of scarce ODA, and how do you combine that with your own blended finance program?
Great, thanks. And I think this joins up with some of the other points that have been made about the MDBs and DFIs already, but the MDBs are pivotal in private capital mobilization in PCM. They help attract private sector investment, particularly in markets where local investors are hesitant to go, or even are uninterested in going, not even just speaking about international investors, right? So they're innovating, especially in optimizing their balance sheets. The mandate has been clear. There's some really important work being done, and there's growing momentum to enhance how they crowd in private finance. There's very strong messages from shareholders about ensuring they're not crowding out private sector investments, right? So I think that's the stage against which some of this is set, and I think it's really important. Canada's contributions, we're working as a shareholder in supporting hybrid capital and portfolio guarantees, both at the World Bank, but also more recently at the IADB and the CDB. So those are really, really exciting new opportunities that we're exploring. The program priorities. So for us, it's about strengthening collaboration with the key actors, including MDBs. So in the work that we do in terms of innovative finance, they are an important player, and we are using the different levers as both a shareholder and as a contributor to some of these funds to try and see some movement on data transparency, on partnerships, on crowding in private sector. And those are really important. So promoting, these are some of the things that, Matt, you spoke about, but promoting standardization, I think, is really critical. And the MDBs are a great place to start for that. They're a real thought leader in being able to push change on some of the things we want to see. Greater impact, greater inclusion in blended finance as well. So the global collaboration, I think, is really important around this. And Canada and other governments have been working together, many of you in the room here. But one of the things we did this year was the launch of the Common Principles for Private Capital Mobilization at FFD4. And for me, it was a really exciting moment because it wasn't super revolutionary. It was a lot of things that a lot of us already know need to happen to be able to make PCM work. But what I think was really exciting about it was how easy it was to find consensus around them, which I think was really telling about where we are in this moment and the opportunity to see change. Within the common principles, there's one principle particularly on MDBs and DFIs, speaking to their essential role in mobilizing private capital, but in terms of also coordination and aligning standards. So this is ensuring that there's complementarity in the actions across actors in the system. Increasing support for private sector-led development in low-income and fragile countries, knowing that they play a critical role in those cases, but then finding the opportunities for complementarity across their books and maximizing private finance. So to truly mobilize private capital at scale, we need a whole-of-system approach, and I think that's what we try to do in our program. Bring together institutional investors, governments, MDBs, DFIs, and donor agencies. So each has a role to play, from exploring opportunities in development finance as an investable asset class, to diversifying economies, optimizing financial tools. It's a lot about knowing, we already know a lot of the problems and the solutions. It's about putting some of that into action and finding ways to better deploy catalytic capital. So we all need to work together on that. Thanks.
Thank you, Geneviève. So it's a perfect moment then to turn to an MDB and discuss how an MDB is responding to the situation. The situation, in a way, is not really new. ODA was never so plentiful that it could be spent without any regard to its efficiency. And the call for increasing the efficiency of blended finance was always there. But things seem to be pivoting now. So, Astrid, how does an MDB like the EBRD is responding to the challenge and to the call for shareholders to increase the private capital mobilization?
Thanks very much, Geneviève. Before answering that, I also really would like to ask us to take a moment and pause and look back how far this agenda has come since Addis over the past 10 years, yeah? Both on awareness and solutions and partnerships. And Convergence has been a major enabler of this ecosystem. So thank you so much and sincere congratulations. Moving on to the topic of the discussion here, basically, for those of you who don't know EBRD, the bank was created in 1990 actually to help the countries of the former Soviet Union in the transition to a market-based and private sector-led economy. So starting out in Eastern Europe, Central Asia, and then expanding into Southern, Eastern, and Mediterranean, and we're now in the process of also expanding into Sub-Saharan Africa. So basically, addressing market failure is in the DNA of EBRD, and we are a private sector-oriented MDB with 75% of our operations going to the private sector. And we believe we have a relatively unique business model in that we combine policy work with investments in order to use investments, leverage investments, to also create the required enabling environment to attract then private sector and other co-financiers in what we do. And in that context, of course, blended finance is a very useful tool, and we collaborate with a number of donors in doing so, including all the 3 governments that are with me on the panel here. So thank you for your valuable collaboration and contribution. And of course, with the objectives to create financial additionality, so really only go where the private sector cannot go yet, in particular in early transition countries. That's still a bit of a challenge, as we know, and also create development additionality. So really use the financing to trigger additional impact that could not be delivered otherwise. I mean, that's really the role of blended finance, isn't it? And we do so by using it across all instruments, so technical assistance grants for the policy work, regulatory reforms, but also capacity building, proper project preparation, very important actually in order to build and accelerate the pipelines that we need to see if we really want to scale, but also concessional loans and increasingly guarantee instruments and also insurance solutions. And EBRD works across its strategic objectives in the green economic transition, human capital, economic governance, but also has mobilization as a strategic enabler, basically. And we do allocate a share of our own net income to these operations as well. So this, through the shareholder special fund, we have a little a pool of money that we can also use for blending purposes. So then if we look at the purposes for blending, you know, how and why are we doing this? Of course, it's first and foremost for de-risking. This was already mentioned. One example I would like to give you here is actually in Ukraine. EBRD is currently the largest institutional investor in Ukraine. Again, very much supported by the donors who are helping us. And so, for example, we were able to provide a guarantee to Raiffeisen Bank, who was then able to provide a local currency loan to the Nadezhda group in order for them to build a terminal that allows to accelerate the import of fuel, but also the export of agricultural commodities, which is of course key in the current environment. But that guarantee we were not able to do entirely on our balance sheet, so we had some partial first loss guarantee from our crisis response fund, which is actually donor supported. So very important that these operations, you know, they enable us to do the right thing and then to bring in the private sector. Second, of course, in terms of delivering impact, you know, one of the topics I mentioned is really financial inclusion, where we just celebrated the 10-year milestone of our Women in Business program, which is a program that has provided over 1 billion in finance to women-led businesses through our partner financial institutions, helping 250,000 women-led businesses in doing so. And we have done some impact analysis for these programs, for example, in Turkey, and it shows very strong positive impact. For example, banks increase lending to female entrepreneurs, but also the companies then actually have a significant increase in their revenues. So these blended finance structures, they do work. And then, of course, third, we are now very focused on scaling and mobilizing in using blended finance. And one example there is that we have partnered up with the German government to support our B-loan syndication program through first loss guarantee and technical assistance where needed. But I'd like to say that we do not depend on blended finance because EBRD is also able to mobilize, you know, in a market-based way through its B-loan syndication program and also insurance solutions. So blending is really important where it is justified and needed. And I think I wanted to make that point here because we are all passionate blended finance practitioners, but in the end, blended finance is meant to be an interim solution, and it cannot address the policy and regulatory failures at transaction level forever. So I think we need to, as we have this discussion, keep the integrated perspective in mind. So now, sorry, that was a bit of a long-winded introduction. How are we seeing the changing environment? I would like to say we really see it as an opportunity because it is an opportunity to take a fresh and very targeted look at concessionality to place it where it is needed in the instrument that is most efficient. So as I was trying to say earlier, we still do need the grant support to get the policy environment right, but in an environment where, of course, fully understood due to fiscal constraints, grants overall are declining, when we're looking at private sector operations, we can do a lot with guarantees, and we are seeing that shift in donor-funded instruments. But as I mentioned, we cannot entirely replace grant funding because then we won't get the enabling environment right. So that support is still very much needed. Of course, the environment is also providing an opportunity to stretch the donor dollar further. We are tracking how much we mobilize directly through every donor euro or dollar provided, and we multiply by 3 on our own account finance and then an additional 5 times multiplier through additional private capital mobilized, and this is only direct mobilization. We're looking to scale that further going forward, and I think the environment really brings an opportunity for innovation and co-creation. Innovation in terms of the instruments, looking really very specifically where in the capital structure can blended finance still fill a gap, looking at more mezzanine finance, for example, patient equity, but then of course also supporting pooled finance and portfolio solutions, and I'm sure we will talk more about this. And it is also opportunity for new partnerships, so to collaborate and deepen with our existing partners and donors, but bringing new partners, such as our countries of operations, such as philanthropy. You know, country platforms have proven to be a very effective framework for bringing everybody together under country leadership, so we can do more of that and scale that. And last but not least, there's an opportunity for efficiency also on how we manage donor funds. Yes, donors are becoming more demanding. On the other hand, we need standardization, we need harmonization, we need also simplification. So we are currently looking at how we process and manage donor funds better internally, but we also have a bit of an ask to our donors that they also join the harmonization wave that the private sector is so rightly asking for.
Thank you very much, Astrid. Very rich set of remarks here. And I think the idea of standardization, not just on the part of a structure, but also as much as possible on the demand and the condition put by donor is really important. If you want to scale, you need to, you can't do bespoke. As much as possible. I appreciate if you're a donor, you have political constraints that sometimes impose condition, but there is a trade-off, and the more specific conditions apply, the less scalable or even workable the structure can be. Fantastic. Let me go back then on the standardization. Geneviève, you mentioned the G7 principles for private capital mobilization. And that's really exciting, the common principles. What concrete changes do you think those principles may bring to the sector?
Sure, thanks. And just before I launch into that, of course I didn't congratulate Convergence, but they're near and dear to Canada's heart. So I hope that was to be taken for granted. I think just in something that you've just mentioned, it's worth putting down a marker that we're working very hard on this question of standardization, but there is a tension between how we can provide capital for things like gender lens investing that requires where women need money in a particular way that works against this movement of standardizing and finding easy solutions. So in our program, we are trying to look at that from different perspectives, because the early stage capital might look a little bit differently than near commercial or institutional investor driven. So I think it's important to say that because we are working on impact across the board, and that does come up. So in terms of PCM and standardization, from our perspective, it's key to unlocking larger volumes of capital at scale. The efforts respond directly to the requests from private sector. So the common principles, I think why they were so easy for us was because the work had already been done and published by several different groups in the private sector in terms of these are the things that we need. And it is about finding the ways for donors to standardize their requests and requirements and going into deals. So the common principles are our roadmap for transparency and alignment between public and private actors. Encourage donors, again, because it's coming from the donors or from countries, sovereigns. They encourage us to rally around the shared themes around PCM. And one of the things that has resulted from that is our collaboration with Germany and other governments and some important private sector actors on Scaled. The Scaled initiative is putting those principles into action. And it's very much about finding some ways of finding easy investment vehicles with standard terms that everyone will already know. Matt, you referred to having easy things in the market that everyone already knows how they operate. That's the intention behind Scaled in terms of how at least donors are coming into it and how the private sector is looking at it. So it recognizes the need for public and private collaboration to overcome barriers to PCM, focusing on alignment of requirements, sharing best practices, and exchanging knowledge, and aims to reduce efficiencies and structural challenges to mobilizing private capital at scale. So standardization for us is about speed, scale of solutions, and efficiencies. So lowering the effort to find common ground for large-scale investment vehicles and enable faster deployment of that capital. So this is examples of system-wide approaches. The principles and Scaled come together in practical ways to unlock private capital at scale. I would like to include in this, though, our efforts around data transparency. The Hamburg Data Alliance is one piece, but there are others, and many of you in the room working on this. But Canada is working very hard across these efforts on data transparency for availability and accessibility of quality data in emerging markets for everyone. This is a real, I think, key piece of unlocking the real risk is enabling environment regulatory. We've talked about that, but about the perceived risk. So this is about harmonizing data sharing practices, being more comfortable with the information that we share, ensuring risk, return, and ESG data are comparable and accessible for investors, and helps investors distinguish between the real and perceived risk, which I think is really critical for PCM. So final thought on standardization, I think it's really critical for achieving PCM goals, but it does require some time and effort and collaboration across multiple actors and players. And Canada at least is trying really hard and working with many people in the room on trying to push that forward. So we hope to contribute some solutions with others joining us in this work and recognize that we really need long-term integrated approaches. So thanks.
Thank you very much. And I'd like to go a little bit off-piste now to put that question of data transparency to Astrid. And sorry to put you on the spot, but Convergence has been calling for transparency, and we know that the transparency, certainly coming from MDB, is still not really fully there. The GEMS database is great progress, but there's been a call for much more disaggregation. How do you think an organization like the EBRD could improve on data transparency, especially when it comes to blended finance program?
Yeah, thanks for that. I mean, we signed up for the blended finance DFI principles, right? And they include high standards, including transparency. So we are committed to that. And we are discussing actually what the MDB community can do together for transparency in the DFI working group, because you will understand it is beneficial that we agree on approaches, methodologies, and measurements before we put data out into the ecosystem. And it is not an easy topic, of course, but EBRD is committed to transparency. You know, we have a grant equivalent calculator that we use in order to review projects internally, but that's already where things are starting to become difficult, right? I mean, do we all look at the same question in the same way, or do we calculate differently? So we need a bit more time to get to, I think, standards and solutions that everybody can sign up to. But in general, fully understood that transparency is an enabler for scaling up blended finance.
Thank you very much, Astrid, and looking forward to see how those discussions evolve, and fully agree that a coordinated approach would be extremely beneficial. MDB DFI should work together with the same standards, otherwise you end up with data you can't work with because you can't compare them. Fantastic. Going back to Christian, you mentioned that SECO deploys mostly TA grants, but we also heard that there is really a trend towards guarantee, and I understand that there is also some thinking whether guarantee would be a relevant tool. Can you tell us more about this?
Yes, I think we really see the setup and use of guarantees mechanism increasing both in MDBs or by MDBs as well as by bilateral donors, and I think there are really good reasons for that, as we heard. And in Switzerland, we're also looking into how we could do more with guarantees. But let me start by saying why we see this growth. I think first, there's solid evidence of efficiency. So studies consistently show that guarantees, and particularly portfolio guarantees, are among the most effective blended finance tools in terms of mobilization per concessional dollar. And I think that one concrete example close to us is Garanco, the guarantee arm of the private infrastructure development group Pitch, which we co-founded with the UK, Netherlands, Sweden in the early 2000s, and we have Australia, Canada, and others joined. So over the past decade or decades, Garanco has seen losses around 9% with 2% recovery. So we're talking about 7% net losses overall, and its guarantee commitments have been used are used in general 3 times. So mobilizing around $5.7 billion since 2005, with only a bit over $300 million in paid-in equity. And so that's a really strong leverage and very good value for money. But I think beyond that, it's also conceptually very powerful because they have a demonstration effect, as we've heard before. They provide real-world evidence that the perceived risks of investing in emerging markets is often higher than actual risks. And if we apply guarantees repeatedly and systemically, you can track how concessionality levels decrease over time as the markets mature. And I think a good example there is the green bond issuances for sustainable student housing in Kenya done by Pitch. I think the first issuance was covered 100% guaranteed by Pitch. Second only required partial guarantee, and now domestic pension funds are financing the projects directly with no guarantee at all. And by the way, the standards that have been used for these sustainable buildings, they were EDGE certified, so it's a sustainable construction standard for emerging markets that was supported as well by SECO about 10 years ago. And it has also been recognized as a qualifying certification system of the Climate Bond Initiative that we supported as well early on, just to showcase again this combination of enabling and mobilization efforts, I think is really critical. So yeah, it really tells us, I think that's an example how repeated and standardized blended finance transactions create markets and lower concessionality levels to zero over time, which is exactly what we want blended finance to do, be temporary and be catalytic, right? And maybe just to say as well, as Tim mentioned yesterday for Pitch, so there are efforts ongoing to create more local guarantee facilities beyond the ones existing in Nigeria, Pakistan, and Kenya. So Ghana, Vietnam, and others that are actually addressing the local currency risk, which is a key aspect of quality blended finance, I think, and to also mobilize domestic institutional investors about which we're talking about so much these days. And so this really helps to deepen local capital markets. I think there's also critical work on the way to coordinate much further with the World Bank efforts and also EBRD actually on creating capital markets in emerging markets. And internally, we're also looking at how to receive a mandate actually to explore guarantee options and also in collaboration maybe with others that could be focused on climate and also involve Swiss institutional investors. I mentioned before the trade-off when using grants for blended finance, but I think one practical advantage of unfunded guarantees is that they only require reserves or provisions for expected defaults. And so compared to first loss equity investments, guarantees can often be deployed with less of a trade-off or much less of a trade-off against technical assistance grants that support these enabling reforms. Of course, guarantees do not work everywhere, but whenever this is a feasible option, I think we should go for it. And yeah, ultimately, Switzerland as a mid-sized economy with limited ODA resources, a large financial sector, and a AAA rating still, yeah, we are quite well positioned to use maybe guarantees going forward. And in short, yeah, I think they're not only efficient in terms of leverage, they're also powerful market creation tools and embody what blended finance should exactly achieve, which is temporary catalytic interventions that make themselves obsolete over time.
Thank you very much, Christian. What a great set of examples that illustrate what we're talking about, and the decreasing concessionality is the end game, of course. Hito, last question, and that was mentioned yesterday, the role of philanthropies. I understand that there is a lot of discussion within JICA whether to partner with local philanthropies and join forces. What is the experience so far, and do you think this is looking promising?
Well, thank you very much. Before answering to your question, I just would like to touch upon our new development to increase the blended finance. This year in April, the Japanese Parliament approves the amendment of the JICA law, which enables us to launch new de-risking instruments. Those include portfolio guarantee and the purchase of the bonds issued by local entities, which would create the bond markets, and also the first loss equity investment. So far, only one concrete commitment we have achieved. In August, we have announced that the first case for the first loss equity investment to the fund for African startups. But so we have just started our new journey, so we would like to learn from our partners' experiences. So standardization and also the information sharing, especially the lesson learned, we really appreciate we can learn from those experiences. And answering to your question, our experiences to collaboration with philanthropy is so far very much limited. And one example was the collaboration with Gates Foundation on the loan conversion of the polio eradication. But recently, in August, JICA has signed the MOU with GEP, the Global Energy Alliance for People and Planet, which is working for the Mission 300. So I think this is the first case to work with such as a flexible capital provider. So I hope so we can, how to say, learn and the good experiences to explore the more possibility to work with new partners.
Brilliant, and sounds really promising. We have 8 minutes to go, actually minus 4 seconds. I've got a timer here. I think we can now open questions to the public, and there are some microphone cubes which are thrown, or actually delivered gently, most cases, for questions. Joan?
Joe.
Is one?
Ready, Joe?
Keep the day job. I was curious, two of you, JICA and SECO, both mentioned needing to keep taxpayers happy with official development aid, that there's declining support. I was wondering what kind of transactions happen, what kind of themes you pursue when you need to think about national interests in addition to development interests. Thank you. What changes?
Great. I thought there was someone there. Yep, there is one here. Perfect.
Hi, Dan Zook from ISF Advisors. With decline in ODA, I was curious about any instruments or tools or programs to mobilize domestic capital from within emerging markets, unlocking domestic pension funds, high net worths, or that type of thing.
Thank you. We can take a couple. I'm going to use my privilege just to tap into, we heard from Hito about the experience of joining forces with philanthropy. Maybe Geneviève or Christian, if you have such experience, would be great to hear. Oh, there's one question.
Hi, Mr. Resnick, Federated Hermes. Christian, you made the point, I think it's one of the important points about blended finance, that it shouldn't be relied upon in perpetuity in current situations. Obviously, there'll be continued need and it'll grow and grow, but in that example, for a while, the risk mitigation component compressed to not be needed at all, I think is super interesting. Is there an example on the return enhancing side of blended finance that shows that as well from the panel or maybe from someone else? Thank you.
Thank you. And we'll take a last one here, and then we'll give you time to respond. And if we still have time, we can do another round of questions.
Yeah, good morning, everyone. Bahagi Burhani, independent consultant representing GOPA. GOPA is a German-based consulting firm. So yesterday we had a really rich discussion, and one of the key points was the reduction of ODA and even blended finance into LDCs, a significant reduction, which means, again, reduction to the fragile economies, right? They're the hurt the most. So I'm wondering if there is any strategies focused on fragile economies, given the challenging circumstances we're in. Thank you.
Great. So we have a question on how to keep taxpayers happy example of mobilizing domestic capital, the role of philanthropy, maybe example illustration of how you decrease concessionality, but also the return, the rate of return, and then how to deal with LDC, fragile and conflict-affected states, and concessionality. Who wants to take what? Yeah, go for it.
Can just start, and maybe just very quickly to some of them. So on, I think the effectiveness or the skepticism about the effectiveness of ODA is not necessarily always linked to the national interests. It's a side, and we have to tackle it additionally. But I think it's partly also a communication question, and to some extent we've sometimes worked on the enabling environment, but at a maybe very high level that is very indirect and long term. And I think there we have to come a bit to the realization that we need to be maybe step down a bit, focus more on some countries, sectors where there is an imminent commitment, political momentum, and combine it maybe with some quick wins that are also politically attractive and feasible to showcase in shorter time. And I think there to yeah, I mean, some sectors that are important for Switzerland could, of course, also be, financial sector, infra, etc. There are many, actually, as a very diversified economy. So we have a lot of options. It depends probably per country, but to also really work on maybe some of the enabling environment in certain sectors and countries that are especially important for the Swiss economy. And I think on domestic capital, I mean, I mentioned the work that Pitch is doing and we're supporting, but we've also been active for, the past decades actually to build local capital markets more through regulatory reforms and including as working on the first step, which is oftentimes money markets, also through the EBRD. So I think this will continue and will only grow in importance at SECO to really work on domestic capital markets. And yeah, it's also a necessity because in the current macroeconomic conditions. I think the enhancing returns, a very interesting question that I think we discussed with Convergence a few years back, but I think it's just politically, it's much more sensitive to ensure a return in comparison to mitigate a risk. So that's a bit the issue we're having there. And then to define which would be the right return, right? And I think on LDCs, I think it's worrying to see. To be a bit provocative, maybe it's also a bit of a correction of using the right tools in the right places. I think we have quite some discussions with our Ministry of Foreign Affairs as well, and I think in some areas it's also really important to work on the macro, on the debt management, etc.
Thank you. Astrid, you want to take any?
Yeah, maybe a specific example. It is specific, but it works on blending in fragile settings and local investment. I'm coming back to Ukraine because actually there, as I mentioned, we have been able to use blended finance to generate quite a bit of investment, in part on our own balance sheet, but also from local banks and also local equity investors, thanks to some of the limited donor fund support that we have been able to receive there. And it's actually quite impressive, I find, that even partial first loss guarantees from donors are able to unlock, a multitude of funding sources into a war setting. So it shows the power that blended finance can have also in crisis regions. And we are using that experience now to try to replicate similar approaches in West Benghazi, Lebanon, Jordan, and other crisis settings.
Do you want to take any? Oh. Hito?
Yeah, just quick response. To make taxpayer happy is very, very challenging. So, there are many layers of the taxpayers, but our president of JICA tried to bring back the value of soft power. So soft power, we haven't heard often recently, but we try to bring the value of soft power. That is the basis to work with the neighboring countries, and how the international works based on the soft power. So those might be the better narrative to be for the taxpayers. Thank you.
Geneviève, do you want to take a few questions?
I'll do it very quickly. I see the blinking 0. But yes, I would say that we make a distinction between how we tell the story of ODA versus how then we look at the themes for investing in terms of national interest and development interest. And that can be done in a lot of different ways when we talk about vaccine for global health, for stability in Canada versus economic growth and prosperity and how that impacts domestically. So we can tell the story in different ways, and it's not always a direct line in terms of our actual investments. The domestic capital mobilization is really important, and I think we see that at the transaction level. We're always intermediated, so it's not necessarily something we see at a fund level, but it will be at the transaction level. And when we look at it, we're talking about scalability even for early stage investments, so it's a really important piece in terms of the sustainability of the investment. Risk mitigation versus return, I would just say what Christian said, because we can't be subsidizing returns, but we can be lowering the risk and making it possible to bring in the private sector, and that's the perspective that we bring into this. And then in terms of LDCs, again, Christian said it, we're not trying to use this in every situation. Blended finance is not appropriate in all circumstances, but we are looking at where there are opportunities and innovations, how can we do that? And it's not happening within traditional humanitarian settings, so how can we explore the opportunities there? So, thanks.
Great. I think we step in the shoes of development actors, development partners, and I think it's been a very, very rich discussion, and I'm energized by the creativity and the willingness to push the envelope, even in difficult circumstances. So thank you very much for a great panel.